It's Friday already. Hey everyone,
Friday.
thanks for joining us and hopping in here. We are going to give it just a few seconds before I think we get going. And we're going to start out by hopefully getting those of you that are hopping in here now. I see a bunch more people hopping in. We want you to chat with us today. So Amy is going to, in the background there, share a little poll that we have that we would love it if you share your vibe for Thanksgiving turkey. What's your go-to? We want to know what you're thinking and what's going to happen this last week. We were talking before you hopped on here, and we feel like it's already month end with the holiday coming up. So I think we'll go ahead and get going. So thanks everybody for joining. This is the latest in mortgage today. I feel like I know probably most of you who are in here, but if I don't know you, I'm Faith Howard Mooney, the SVP of Member Engagement here at the Mortgage Collaborative. And with me today, I have Kelly Haney, who is the EVP of Capital Markets and Systems Strategy Manager at Mortgage Financial Services. Thank you for joining me, Kelly.
Of course, it is
Yeah.
basically month end because next week we have Thanksgiving and turkey.
Yeah, I know. Isn't it crazy? We were talking before we hopped on here, everyone. Would love to know if you all are feeling the same way or if it's just us. Boy, oh, skip the turkey? Wow. Wow, that's a surpriser on the poll there. We have a big percentage of skipping the turkey. But yeah, so we were talking about how quickly we feel like the year has gone. It's been a year of a lot of change going on, lots of things happening, volume now picking up a little bit, which we'll talk about in just a minute. And so we were chatting about that before we hopped on. But as other people hop in here, if you're new in here, take the poll and tell us how you're feeling about the turkey issue for this next week. Um, the latest in Mortgage Today is a place where we like to talk about what's new in mortgage, what's working, what's shifting, and what it means for all of you in your daily business. It's a space where we want to listen, exchange ideas, move things forward together if we can, and build a space where you can have a say, speak up, voice your opinion. So that's what the chat is there for. That's what we would love you to do with us as we talk about things in here today. This event happens twice a month on Fridays at this time frame. So register if you haven't, get your team in here to hear what's going on and have a good chat with us. So Kelly Haney, you have been with us on a number of different occasions before. I feel like you're pretty well known within the TMC family. But you want to share a little bit about your role within Mortgage Financial Services and what Mortgage Financial Services does so everybody has kind of an idea of where you're speaking from?
Yeah, so Rose, a little, I think a lot of us have been on the IMB. We wear multiple hats in our business in today's economy and where we are, but oversee capital markets is our primary functionality of handling our rate sheets, our hedging positions, and all that fun stuff, and pushing out the rates and getting yelled at by our salespeople because somebody's always better than us. On the flip side, and then the other side, I manage our systems, our Encompass and point of sales, and really help administer and the focus on that. Mortgage Financial, we're a independent mortgage banker. I kid people we're about the SEC conference because we're in the southern states. About 13 states we're licensed in. We have a retail channel and a wholesale channel. So I bring a little bit of that aspect of dealing with the brokers, sending us their business, as well as a small non-delegate channel we buy loans from. So very excited to be part of this group. The Mortgage Collaborative is a tremendous partner of MFS, and our team loves being part of the conferences and the monthly calls. So
Well, and we love having you. You've got a great group of people you work with. Do you have a special hat? There is a question in the chat that says, speaking of, where is your hat, Kelly?
I didn't bring that one today. I had a turkey hat, but I couldn't find it. I think one of the kids took it. I was going to put on. But wait for the Christmas sessions. We'll have some fun in December because someone said each call is going to be themed. So
We are. We're going to theme our working group calls in December. So everybody start, as you're pulling out your Christmas stuff after Thanksgiving, start pulling your outfits if you have them for the holidays.
Yeah.
together. Yeah, so let's get started here talking about, I mean, one of the things that has happened since we last got together is there's been a little bit maybe of a rate drop. Average rate for the 30-year fix when I pulled it was 6.24%, lowest point in over a year. Would just love to see how and if that has impacted your business. Have you seen things change? What are things looking like right now?
Absolutely. It's definitely nice to have it come in. I think definitely seen an increase of business. Kind of going into the fourth quarter a little busier than we did a year ago, which is very positive. And looking at what our lock increase has been going into the first quarter is going to be a little bit stronger than in the years past. So we are excited about that. I think I think the market has come to a realization that rates are kind of where they're going to be, plus or minus a little bit. Obviously, we're not going to see a permanent interest rate in the low fours, threes, I think, anytime soon. So definitely seeing that improve with locks coming in and business picking up and a lot more energy talking to our partners and our realtor partners that we deal with. So
Yeah. Yeah, I think that overall we've heard, within the network that people are seeing that. It's kind of a nice way to end the year, at least on maybe a little bit of a more positive trend. See things ticking in that way. Do you think that with that and kind of things maybe settling at kind of where it's at and people feeling that way, do you think that's going to cause maybe a few more people to start moving because they know there's not going to be maybe a big fluctuation from that than what they have in the past? Or do you think that has any impact at all?
I think it will. I think going into spring, you're going to see that when the busy season comes upon us of people really going, okay, here's the reality we are is, and you're starting to see a lot more refinances come in the market, taking that cash out from people who not necessarily can buy that new house. But I think with what's going on in the market, with a lot of the talks on LLPAs being revisited, I know I'm an advocate to we need to relook at the refinances. They've made it so hard with the cost on the Fannie Freddie loan level price adjustments on that. So
Yeah. Yeah. Well, let's talk about something else happening. You said Fanny, so we're gonna shift a little bit to talk about Fanny. No more hard 620 cutoff announced in Hampton, so it won't automatically disqualify borrowers with credit scores below 620. But and this was as of November 16th, so five days ago, or at the beginning of this week, I guess. How do you think that impacts, I guess I just want to know from you what you think the impact of that will be. Does that mean that more people will now qualify, or, does it bring a whole new pool of people in?
yes and no. What it done is it's give the marketing people something else to talk about. That they're able to do that marketing press. That there's no more minimum FICO on paper with the agencies. Uh, but if you really dive into the price adjustments, I think reality most of your borrowers are going to go to that FHA market. Many of the MI companies have already came out said, "Hey, we know what they said, but we still want a 600 if you're having MI, unless you get an exception." Uh, I think the re-looking at the credit, I think the score mechanism does need to go away, and common sense needs to come back into that. And AUS is positioning itself to look at, do you have that rental history, looking at a recent. But I challenge everybody to really utilize your tools and do your comparison. What makes sense? Is it that FHA for the first few years? Get them on that path to get their score up. I'm curious to see. I've not seen one come across my desk this week of locking on that because it just got launched last weekend with new case file IDs. But I think
Yeah,
the loan level pricing adjustment is going to make it especially that higher. What is good about this is it does open up that market to your borrowers that may not be eligible for FHA financing as a game plan to put them in there, your non-permanent residents, for example, that FHA doesn't do. So I think
yeah,
it definitely gets a conversation piece. And in today's sales world and when our salespeople are out on the streets, it's another conversation to, hey, do you know Fannie Mae did this? Gets the door coming in and have that conversation.
yeah, yeah. It's a great, I mean, if nothing else, education tool to be able to talk with people about it, something new, but you can still talk about all of the other things related to people qualifying in that same conversation. I would agree with that. Do you think it expands access to people that have maybe a little bit lesser or less traditional credit histories as well?
I think it does. Fannie's been doing the no credit score for a little while with the compensating factors and able to document it. So I think it does. I think credit is such a topic. There's a lot of topic with Advantage coming out. It's coming out
Yeah.
and I could tell you, it's so funny. Speaking of credit, we get the notice from one of our vendors, prices are going up. So we're always visiting, looking at it, right?
Yeah.
Uh, but I think that's part of kind of the problem we have with Pulte and the managers. They make these announcements and really don't understand what they're saying because they're not out of dealing with what we deal with on the street every day.
Yeah. Yeah. I oftentimes wonder, though, whether that is almost like a planned event. So, this is how my brain works a little bit. Is it really just a planned event? Because the one really good thing that I feel like some of those things that has been caused by some of those things or has happened because of those some things, it does get people talking. I mean, it does get people talking and it does maybe get people thinking a little bit differently. So it makes me wonder whether that's almost the plan related to that.
Yeah. Let's get some excitement in the mortgage industry, and besides the negative stuff that is out there of, hey, we're opening up the expansion, and then little asterisk that your government defaults keep going the wrong direction. So,
Yeah, yeah, I know. There's always something going on for us. One of
yeah,
the other things that came out kind of in that same way, so we did a good transition into this one that kind of came out that same way, is the very brief conversations related to proposed 50-year mortgages. Kind of came out, I think it was was it over the weekend? I think it was over a weekend when it came out. It may have been a couple of weeks
yeah,
ago. Um, so it's like we've had 40-year mortgages for a while, never really, gained traction. And now we've got, the proposal initially coming out of a 50-year mortgage. So share with us kind of what your reaction was when you saw that coming. And we've got Mark Renault in the chat commenting on his opinion. Thank you, Mark, on that.
it goes back to another way to fix affordability, right? So you give them 20 more years to make a payment that's going to save them $200 on a $200,000 loan, give or take. The reality is the first half of that's interest only now. Uh, One out of 100 borrowers, I could see this actually being good for. To be quite honest, I think the bigger issue is the affordability. That's what I think everybody on this call could probably vouch. The issue you have right now is affordability of getting new home buyers in, right?
Right.
Extending the mortgage term does not fix that. And I'm based in Texas, Dallas, Fort Worth, that homeowners insurance is increasing on average 19.2% in Texas. Property taxes are going up 3 to 5% a year. So you're still not solving affordability. I think if the government, when I say that very, we should not have them in our business, but if they were to do anything, is they need to really look at the insurance business. But I think this is another marketing. A lot of people commented. I was sitting there watching social media feed and watching realtors and builders talk about this. And I'm like, oh my gosh, I don't know what you're talking about. It's an interest only loan. Let's call it what it is. Uh,
Yeah.
but I will play devil's advocate a tad. How many borrowers stay in it for 30 years without refinancing it or selling? So if it
Mhm.
does open at affordability, and I know a lot of you are going to disagree with me, for that little 5% people to get them on the track may not be a bad thing. And reality is they're going to refinance in the first 7 years. The
Yeah.
not many borrowers stay in that current loan greater than there is that percentage, but
Yeah.
it does open that door to home ownership a little bit, not a lot. And I'm not saying it's good. I don't want anybody to say, oh, it does open the door a little bit, but I don't feel like it's the best solution to fix the real issue, which is affordability in the market.
Yeah. Well, when I looked at this, one of the things that I looked at, number one, part of it is just my age. It's like, a 50-year mortgage isn't going to apply to everybody, right? But if it does bring those younger buyers in to the market, that's one thing. The reduction in the, monthly was found 148 to $216 compared to a 30-year loan. So not a significant amount. And then does it add more cost because of the longer term of the loan to an average loan? So as like a trusted financial advisor of individuals coming in, now you said they won't stay in there, and maybe that's the caveat that goes with it. But if you thought that somebody was going to stay in their house permanently and be in that house as a trusted financial advisor to that person, is it good to spread it out over the course of that and have them paying anywhere between 170 to $200,000 more for housing?
Absolutely
Or
not.
yeah,
Well, you bring up the question, 30-year notes, and we, the lenders, ain't supposed to look at the borrower's age when making decisions. But I mean, lenders, we're on the hook. And you start looking at these loans, and someone's wanting to do a 50-year note that may not be the youngest in the neighborhood. It really brings up, okay, what is our risk for affordability? And those of you that service your loans, you understand what I'm talking about. You're still responsible for payments, taxes, and all that until stuff gets handled. So, if this was someone, it was going to be their dream house, they're going to live in it the rest of their life. This would be the last product in the world I would present. Uh, I just very honest, I think what they're trying to do is accomplish some of the affordability issues. And that's what it boils down to is even today, the American dream is for home ownership. And so they're trying to find ways to do it. Uh, but I think we've done a good job with what's on the market, the temporary buy downs, utilizing seller concessions to permanently buy down these rates. Uh, LOs, the LOs that are still in the market are, how do I say this? They've exceeded expectations. A lot of the ones that did it just to get quick cash during the refinance boom, they're not in our way anymore. So we now have highly educated people that you nailed it, that we would consider true financial advisors
right.
on that mortgage piece.
Yeah. Yeah, that definitely is the upside of some of the things that have happened. Other things related to this that, of course, would have to, these are not conforming loans. So they're not conforming loans
Mm.
if they're done.
Yep.
They require legislative changes to have any impact at all, maybe. And then the other thing that I saw that I would just love if you could just kind of give an opinion on is, if this happened and supply of housing isn't addressed, does something like this, if it's attractive to people, does it inflate home prices because there's more demand out there? I mean, do you think that there's enough of a pool that this would ever capture that would cause that to happen? My opinion was no, but I'm
No,
not on the
there's not
fence like you
enough.
guys are.
Uh, I don't think there's enough pool. I think this is a very small percentage it would attract to even be interested to do it. Uh, again, it's a failed attempt on affordability. That's what I think it is. And not to get into the politics side, is people are making decisions that don't understand what's going on. They don't understand the risk that we're dealing with, that we're trying to put borrowers in position to keep the house. We're not doing the loan just for the closing that happens on November 21st, right? We want to make sure that they stay in that house as long as they need to. And when you're analyzing these borrowers on risk, there's so much that we don't even take in account when their qualification, from the cell phone bills to little things that just add up. So I don't mean, I think this was just a couple of politicians over a cocktail laughing, making say, hey, let's throw out this 50-year and get everybody talking.
You never know. I mean,
Yeah.
it actually could have been. The other thing that came to mind as I was thinking about this is, well, number one, I've never stayed in a home that long to pay off an entire mortgage. I don't think I think a lot of people are more transitional now than maybe they used to be in the past. But also is like, does it look different because you would have to look at the collateral that you're going to
Yeah.
have in a different way as well, because we know that homes age just like people in those homes age, and things happen in homes,
Yeah.
and so does that piece of it also look a little bit different? That was the other thing that I was thinking about. But that kind of leads us into a different conversation that came out shortly after this one, actually, like kind of directly behind it. is the thought concept, which it was spun when I saw it as a new concept. This has been going on for like a long time of portable mortgages. I grew up in the mortgage space in relocation. That was it started in 1992. They were talking about portable mortgages back then for that population of people. So do you think that I mean, I guess what are the big impacts that you see of something like a portable mortgage, not only for people, but also for our industry and for the lenders in our industry?
Yeah, that is reinventing the entire ecosystem of our systems to be able to do that, to be able to do that. Uh, it's kind of out there with your first time home buyers with the if you can get a good property to assume the current note. But when you talk about the portability, I mean you're disqualifying first time home buyers right off the bat because they have nothing to port over. Uh, Again, we've talked about this since the '90s, and
Yeah.
I did. It's a logistic nightmare. I don't know how you could do it without causing a just nightmare because as lenders and servicers that are valuing these loans, you're valuating the net worth over the X number of years when you're putting your price to the street of your multiples and what your servicing value is. So you got a borrower coming in right now. Your average rate to the street, say, is 6%, and then you have this 3% that comes in. How do you pay an LO? How do then you deal with the comp rules because obviously that loan's not the same value. And does this, then it sounds like this would be honestly, a big bank product anyways. And, for the IMBs on the road and a lot of the people on this call I know that are smaller, mid-sized like us, we have a small servicing platform, but not a billion dollars like the big dogs. How do you do it? Because how do you structure that? Because your pricing mechanism is you're not going to be able to price the loan for profit. How do you manage it for profitability, income, revenue? There's just so many things that have not been addressed.
Yeah.
And
Yeah.
as the numbers guy, that's what I look at all day is my loan's worth this. I pay an LO this. It costs me to produce this. I'm making 50 cents on this loan.
Yeah.
That's a
Well, the
great
other
deal.
thing, yeah, related to that is not only like what you're making on the loan, and then it's like what the cost of producing a loan is right now. I mean, does this make it less for the consumer? Because I mean, in everything that I've read, you're going to have to requalify. It's not just portable
Yes.
when you move with it, right? You're gonna have to
Yeah. You,
requalify. And so unless I feel like unless the rules were changed about like what are you going to look at when you requalify, are you still going to incur all of those fees that you would incur if you were refinancing? I mean, what does that look
yeah.
like?
Yeah, no one knows. And you're right. You still got to requalify, which then, all of our highest expense in doing what we do is FTE employees. After that, your technology costs. So you're still having to do it. You're having to update your technology to accept it. And again, how do you price that loan? Do you put your MSR value on something that's 5 years old that's at a note rate of 2.75? It just you're going to lose money. It does not make sense. And needless to popular belief, we are all for profit in this business. No, we're not nonprofits. Even our credit union partners are there to make a little revenue and income.
Yeah.
The books look different, but they can't operate at losing money on every loan.
Yeah, exactly. The other thing that because it was you that was going to be on here, and we know that you have a strong cap markets background, it's like if this is the case and it's portable, does that mean that it's sold to an investor like it normally would? And does that pool of people? I would assume it wouldn't necessarily be everybody that is working in the first mortgage space now that would want to participate in there. So does that upend
Yeah,
that piece of the
uh,
process as well?
it does. Do you put a cap on it? Are you able to do it one, two, three times, and then you open up one of the most one of the common things that we deal with on a day to day in our industry is occupancy. Is it truly the occupancy misrepresentation is going to be such a higher risk because you're literally and you do it okay, you can do it one time, but if you do it three, then it's you put a cap. You're going to
Yeah,
let them move this mortgage to their 10th house in 30 years.
yeah. Well, and some people, I mean, if you're looking at, utilizing it in some of the spaces that would make sense, the normal cycle in a relocation is somewhere between 18 and 36 months that somebody that's on that career
Yeah,
path and their big companies moving them, that's exactly what it would be, about 10 times in 30 years
yeah.
potentially. So yeah, so very, very interesting. So we were talking as we got onto the call here today, like how quickly it seems like 2025 has gone in many ways. It seems like it's just flown by. I feel like a lot of things have happened. So everybody right now is talking about rolling into 2026 and, what does that look like for people? I feel like a common thread that we've seen not only with our TMC lender members, but in the industry is people looking at how you can do things with lesser employees and have those employees more engaged on higher level things that they need to be involved in. So I feel like lenders, if they're going to invest somewhere in technology, it's probably in something that's, AI driven underwriting for faster approvals and some of those things. What do you feel like, if people aren't working on some of these things right now, and I know you guys have been, but if you're a company that's listening in and you haven't adopted acceleration of the technology that's out there, where do you think they should be starting? What's the easiest
Man,
place to start?
it's not easy. I'll leave it at that. And as technology is becoming more and more robust and dependable, and dependent on outside parties, right? So I'm sure 80% of the people on this call are on Encompass. I'm just going to go out on a limb. And in the last month, we've had multiple issues with the Encompass system, right? Yesterday, their compliance system, maybe it was down till after 6 o'clock Central.
I heard that. Yeah.
Complete disruption to our system, right? Uh, I caution with AI. I love AI. I use it every day in my workflow. I use it for business. I use it for everything I do. But I am a little scared of it a little bit. Of AI is only what we put into it. It's
Right.
still a human building it. So is there going to be some consequences with qualifying borrowers only looking on paper, not understanding that? And AI is not going to be able to read that explanation letter on a marginal FHA loan, determine if this loan makes sense, right? One thing that I tell, and I consider myself the disruptor of my group because I'm the one pushing for the new technology within our team, pushing for the change. Uh, it's not to replace our FTEs; it's to be able to get them to do
Yeah.
a couple more things. Your highest majority of our companies, with the exception of your management teams, your highest FTE is your underwriters. How do you get them from doing, if their number's 3 a day, to doing 4 a day, to accommodate the increase in business that is going to come the first quarter, into the first quarter, second quarter next year? I think you all will start to see that increase come in. Uh, that's how you utilize technology. Is how do you improve your processes and do your checks and balances to ensure the data you're getting there. But here's on the flip side, AI brings a whole new level that I think everybody needs to be cautious of. You can go on Chat GPT right now and say, make me a pay stub for American Airlines, and it almost does it perfectly. You got to know the prompts to put in there, but you open up as the underwriters just catching the misrepresentation. And uh, our friend that's a member of our group, the TMC FEME, is like, get the borrower out of the way and go straight to the sources. That's his favorite thing that he says. Uh, but I think we as lenders are going to have to do that. But then we start talking about cost. All of
Yeah.
these services, I'll pick on our friends at the work number, and nobody on this call says they're their friends. I know that. But you're spending
I'm
a
in if you feel
hundred,
that way.
$150 for one verification that is outdated by 2 to 3 weeks sometimes,
Yeah.
right? And put in the chat box if y'all see the same thing that we're seeing, that you're seeing. We're relying on a vendor that if you go pull a VOE today, it says as of 11/1. What the heck could happen in 21 days, right? Someone could quit, they could resign, they can get terminated. It
Yeah.
And then the agencies, I'll be honest with you, they don't care. I'll be blunt, I got a repurchase sitting on my desk that we met the letter of the rule, but because something happened in that period, they're saying we should have caught it. right? That we're fighting with the agencies, right? But AI brings that whole level of risk. So yeah, you might speed it up, but then you've got to hire more quality control style positions or vendors to
Yeah.
manage the data points that are coming in and say, is this legit? And I mean, it's pretty scary what's on the web. If man, compliance people, I know they I think they're the ones that are dreading this the most because it's I got friends that are teachers. They've had to they built an AI platform to catch the AI writing the project. So you got student doing chat GPT. The schools are paying for this other vendor to put it in there to see if it was a chat GPT prompt. And I'm like, this is crazy.
Yeah.
I'm
Yeah.
like, this is nuts.
QC and compliance definitely takes on a whole different level of, not that QC and compliance wasn't important. I'm not saying that at all, but it like ratchets it up a notch, I feel like when you start talking about some of these things, you better take really, really good care of your QC and compliance
Yeah.
as we
We
roll.
love them, man. Their job's getting harder. I mean, quality control, pre-fund and post-close with what is out there is becoming an extremely tough task.
Yeah.
And um, doesn't take you 2 seconds but to figure it out if you Google and go on the internet of what the heck you can do.
Yeah, absolutely. Absolutely. We're at the bottom of the hour.
But that was fun. Do it again.
I know it goes by so fast. I always say that, but it always does. I was looking forward to talking with you today. It's always such a pleasure. We really do appreciate you and your team. One of the things I wanted to mention before we hopped off here for people who are on here that are part of our network, we just released our Pulse of the Network survey. We would love for you to fill it out and tell us what you want us to do and be involved in. So if you haven't seen that come across your desk yet, get a hold of your member benefits advocate. We would love your opinion. We base what we do based on the feedback that we get from you and what you want to see and what you need. And so we really do appreciate you all. Thank you, everybody, for joining us today. Kelly, as always, thank you for being our host today. Really, really do appreciate you. Have the happiest of holidays, and we hope to see you soon.
So thank you. Everybody have a great Thanksgiving.
Thank you. Bye.
Bye.